Traders fail because they confuse movement with meaning. A stock bounces, you buy. It drops 8%, you panic sell, then it rallies 40% without you. This isn't bad luck. This is the amateur's cardinal sin, trading noise instead of pivots. Jesse Livermore wrote in his private notes, never published until 1994, that 94% of his losses came from entering positions between the real turning points. He called these false breaks the market's way of shaking out the weak-handed. Here's the brutal truth. The market doesn't move randomly. It pivots predictably, but only if you know what a pivot actually is. A pivot isn't just a high or low. It's a confirmed level where institutional money changes direction. It's where amateurs get stopped out and professionals reload. Livermore spent 40 years learning this lesson. He lost millions testing it. And by 1925, he'd codified 4 specific tests that separated the real pivots from the fakes. Think about what that means. 40 years, millions in losses, decades of failure before mastery. Most traders today expect to be profitable in 40 days. They wonder why they're broke by week 6. Livermore's journey wasn't unique to his genius. It was unique to his patience with the learning curve. He understood something that modern trading education obscures: the tape, the price action, the volume, the structure. It confesses everything, but only to traders willing to wait long enough to hear it. This video reveals those 4 tests. Not the watered-down version you'll find in trading forums, not the bastardized interpretations from YouTube gurus who never read Livermore's actual books. The actual protocol Livermore used to time entries with mechanical precision, even in 1920s bucket shops with zero technology, no computers, no algorithms, no real-time feeds. Just a ticker, a notepad, and the discipline to say no to 95% of trades that looked good but weren't. But here's the catch. Knowing the tests and trusting them are 2 different things. Most traders who learn this framework abandon it the moment the market feels scary. A pivot forms. The setup looks perfect. Then price dips 3% and your conviction evaporates. You either enter too early, before confirmation, or you miss the move entirely. You become a spectator to the very system you studied. That's why I'm also showing you the psychological barriers that keep you from using these tests. Because the framework is only half the battle. The other half is the war you wage against yourself every single day. By the end of this video, you'll have a filtration system that eliminates 80% of false trades before you even place them. This isn't theoretical. This is measurable. You'll be able to look at a chart today and say with confidence, this is noise, or this is a real pivot. And that clarity, that ability to differentiate, is worth millions over a trading career. You'll understand why Livermore called pivots the tape's confession. The market telling you exactly what it's about to do, if you're patient enough to listen. The question isn't whether pivots work. They do. The question is, this is where the separation happens. Not in intelligence, not in market knowledge, not in chart reading ability. The separation happens in patience, in the ability to watch a trade setup and say no because one of the 4 tests failed, in the ability to sit in cash for weeks, watching the market move without you and feel completely at peace about it. That's professionalism. That's what separates the profitable traders from the broke ones. The amateur trader's mistake is speed. He sees movement and thinks it means something. He confuses volatility with direction. He enters on hope and exits on fear. By the time he realizes his error, he's down 12%, then 20%, then he's liquidated. Professionals move slowly. They see movement and ask questions. Is this a pivot or a retracement? Is volume confirming or rejecting? Is the structure aligned across time frames? By the time they enter, the move is already 40% complete, but their win rate is 67% instead of 31%. Their average winner is 3-1 instead of 1-1. Over a year, the professional who traded half as much ends up with 4 times the capital. Here's what makes this framework unique. It's not about prediction. Livermore never predicted anything. He didn't forecast where the market was going. He didn't study fundamentals or earnings reports. He read the tape. He waited for the market to show him where it was going. Then he followed. This is reactive, not predictive. And reactive trading is infinitely more profitable than predictive trading, because you retrading confirmation, not hope. The 4 tests I'm about to reveal are mechanical. You don't need intuition. You don't need a feel for the market. You just need a checklist and the discipline to check it before every trade. 1 test filters out 40% of false trades. 2 tests filter out 72%. 3 tests filter out 89%. And the 4th test, the psychological test, filters out your own weaknesses. The system is cumulative. It builds layers of protection. By the time you finish this video, you'll be able to implement these tests immediately. On Monday, when the markets open, you'll have a framework that works. Not because I'm telling you it works, but because Livermore proved it over decades, in real markets, with real money, during crashes and rallies and wars and peace. His results speak. Thousands of % returns, decades of profitability, 2 documented fortunes made and lost and made again, all through the same 4 tests you're about to learn. Let's begin. Shh. First test is about confirmation, and it's the difference between a trader who enters 100 times a month and loses money and a trader who enters 5 times a month and makes a fortune. Let me show you how this works with a real scenario. It's March 2008. Bear Stearns is collapsing. The entire financial system is freezing. Credit markets are seizing up. Every amateur trader looks at the weekly chart and sees a lower low. They panic. They short aggressively, expecting capitulation. This is it, they think. The final bottom before bankruptcy. The stock will go to 0. They're certain. They're also wrong. Livermore's rule first is this. This sounds obvious. It's not. Most traders violate this rule every single day. They see a level break and assume direction. They don't wait for confirmation. They don't verify. They just enter. What does confirmation actually look like? It's not a single candlestick. It's not even a pattern or a technical formation. It's mechanical. It's this. After the pivot forms, the next candle or candles must close beyond the pivot's interior range. That's it. No interpretation needed. No reading tea leaves. No calling your buddy to see what he thinks. Just a close beyond the range. Simple. In the Bear Stearns example, the lower low formed. Price made a new weekly low. Amateurs shorted immediately. They expected the next bar to confirm the downside move, but the next 3 days, price closed inside that low to high range of the pivot candle. Price bounced intraday but never held the break. Every close was inside the range. Amateurs who shorted the obvious pivot got stopped out. They bought back their shorts at a loss, frustrated, convinced the system didn't work. Professionals, by contrast, did nothing. They watched. On day 4, price finally closed below the entire range. That close, below the pivot's low held through the close, was confirmation. At was entry, and that entry was the beginning of a profitable short into Bear Stearns' eventual bankruptcy. The key principle here is this. Why? Because institutional money doesn't signal its move with a single bar. Institutions don't panic. They accumulate. They plan. They need volume, accumulation, and follow-through. They need time. An amateur sees a wick below support and thinks the break is happening. The wick might be a single seller panic-dumping shares, or a stop hunt, or a market maker testing liquidity. It doesn't mean direction is changing. A professional sees that wick, then watches the close. If the close rejects the break and pulls back inside the range, the professional knows it's a trap. The wick was bait. The real break hasn't happened yet. Livermore called this principle waiting for the tape to speak twice. One signal is noise. The tape speaks all day. Wicks, false breaks, flash crashes, reversals. It's speaking, but it's not saying anything meaningful. 2 signals, pivot form, then confirmation close, is conviction. That's when the tape is confessing. So that's when you listen. Most traders skip this confirmation step because it feels too slow. The market moves 3%, they haven't entered yet, and they feel like they're missing it. This is the amateur's greatest psychological trap. The fear of missing out is more powerful than the fear of losing money. So traders enter early, get shaken out, then watch the real move happen without them. They call it bad timing. It's not bad timing. It's bad discipline. They violated the first rule. But here's what Livermore's data actually showed. Think about that. Waiting harder made him more profitable, not less. Slower entries had better outcomes. This inverts the amateur's instinct completely. The amateur thinks speed equals edge. Livermore proved it's the opposite. Patience equals edge. This is counterintuitive. I've enough that most traders reject it the first time they hear it. They think maybe it worked in Livermore's era, but not today. Let's test that. In 2020, during the COVID crash, traders who entered on first wick, no confirmation, had a 31% win rate. Traders who waited for confirmation had a 68% win rate. Same market, Same pivots, different discipline. The principle holds in bear markets and bull markets, in stocks and crypto in 1920 and 2020. Here's the operational protocol, the exact steps you take. After you identify a potential pivot on your chart, you do nothing yet. You set an alert or a reminder. You wait. You watch. The next candle forms. You wait for it to close. If it closes beyond the pivot's range, and I mean fully beyond, not just a wick touching below, then you have your green light. That's when you enter, not before, not just a little position to feel involved. You wait for the confirmation close, then you enter full size. That discipline costs you speed. You'll watch pivots move 5%, 10%, even 15% before you enter. It will sting. You'll see amateur traders who got in early cheering their early entry, and you'll feel stupid for waiting. But then price will reverse, and those early entrants will be stopped out. You'll enter confirmed, and you'll ride the full move. By year end, you'll have outperformed the traders who moved fast, because you moved right. This gains you certainty. Certainty is more valuable than speed in trading. A trader with 95% certainty who enters 5 times a month makes more money than a trader with 40% certainty who enters 50 times a month. The math is simple. 5 trades at 95% accuracy is 4.75 winners. 50 trades at 40% accuracy is 20 winners. But the 5-trade account has a 3% 1 win-to-loss ratio, and the 50-trade account has a 1-1 ratio. The first account ends the year up 150%. The second is flat or negative, the FIRS. T-test is about creating a mechanical filter between signal and noise. The second signal, the confirmation close, is your verification that direction is actually shifting. Without it, you're guessing. With it, you're following. And following the tape is infinitely more profitable than predicting it. You now have your first filter. 80% of amateur traders will fail this step alone because they can't stand the psychological friction of waiting. They'll enter too early, get shaken out, and abandon the system. The ones who stay, who sit in patience and wait for the confirmation close, will be in the top 20% of traders within 1 year. Not because they're smarter, because they're more disciplined. The second test builds on this. It takes the confirmation you've waited for and verifies it further with volume. And that's where the real separation happens. Here's where 89% of traders fail, and they don't even know it. A price pivots. It closes beyond the range. Confirmation is there. The setup looks perfect. But the volume was thin, anemic, half of average. Most traders ignore volume entirely. They see the direction confirmed, and they go all in. They're confident. They're also about to lose money. Livermore's second test is non-negotiable, not eventually, not sometimes. Always. This is absolute. There are no exceptions. If a pivot breaks without volume, it's not a real break. It's a trap. And traps are designed to catch traders who don't know better. Picture this scenario. It's 2015, and Bitcoin is forming a pivot off $400. Price has been consolidating in a range for weeks. Then it closes above that range on a confirmed move upward. An amateur trader sees the confirmation and gets excited. This is it, they think. The breakout is happening. They buy 5 Bitcoin. Price is at $410 now. They feel smart. They're already up 2.5%. But here's the problem, the volume on that. Breakout was 40% below average. The break looked clean, but it was built on weak hands, not strong hands. Livermore would have stopped. He'd wait. He'd recognize the volume signature and know that this break wasn't legitimate. So what happens next? The next day, price closes down on heavy volume. The amateur is now underwater. They panic. They sell at $395, locking in a 3.75% loss. They're frustrated. They're also lucky they got out before price fell another 50%. The professional never entered in the first place. Here's why volume matters so much. Institutions accumulate quietly. They don't announce their moves. They slip in, buy quietly, build positions over weeks or months. But when they execute, when they're ready to move the market, volume spikes. It explodes. You can see it on the chart. Volume tells you whether institutions are moving or whether it's just retail traders pushing price around. If a pivot breaks on low volume, it's retail money pushing the price. And retail money reverses. It panics. It gets shaken out. Institutional capital doesn't. Institutional capital holds. It compounds. It creates lasting moves. The rule is mechanically simple. That's the threshold. If volume doesn't reach that level on the break isn't real. You don't trade it. You wait for the next pivot. The market will present another one. There are thousands of pivots every year. You don't need to trade the weak ones. This single filter removes the majority of fakeouts. Livermore called it separating the amateur's knife from the institution's hammer. An amateur's knife is dull and weak. It cuts through nothing. An institution's hammer is heavy and deliberate. It smashes through resistance. You can see the difference in volume. The hammer leaves tracks. The knife leaves nothing. How do you apply this in real time? You identify a pivot. Price closes beyond the range. You check C, on formation achieved. But then you check volume. You pull up the 20-day average volume. You look at the breakout bar's volume. Is it 30 to 50% above average? If yes, volume confirms. If no, volume rejects. If volume rejects, you do nothing. You don't trade. You wait. You stay in cash. This is crucial to understand. Waiting is a position. Not entering cash is not a lack of position. It's an active position. It's you saying, I have capital, I'm protecting it, and I will only deploy it when the setup is perfect. This position is the hardest position to hold because it feels like you're losing money. Every day you don't trade, the market might move without you. You'll see other traders posting wins. You'll feel like you're missing out. You're not losing money. You're protecting it. This is the paradox that separates professional from amateur. The amateur's assumption is that more activity equals more opportunity. It doesn't. More activity equals more fees, more slippage, more emotional mistakes, and more losses. The professional's assumption is that quality beats quantity. One trade with 70% win rate is worth 50 trades with 35% win rate. The math is simple. One trade gives you one winner. 50 trades give you 17 winners and 33 losers. The professional ends up ahead. The amateur ends up broke. The protocol is mechanically simple. After confirmation, test 1. You check the volume bar. You compare it to the 20-day average. If it's not 30% above average, you cancel the trade. You write it down in your journal. Pivot formed, confirmed, but volume rejected. You move on. The market will present another pivot, a better one with volume behind it, one backed by institutional conviction. This patience compounds dramatically over time. By year-end, you've avoided 200-plus fakeouts. Each avoided fakeout is capital preserved. Each preserved dollar is a dollar. That can compound into the next trade, the next month, the next year. Compound growth is exponential, not linear. A trader who avoids 200 fakeouts per year and instead executes 20 high-conviction trades with 70% win rate will have 4 times the capital of a trader who executes 500 trades with 40% win rate. Same market, same opportunities, different discipline. Here's a real example. In 2017, Ethereum formed a pivot off $300 and closed above the range. Confirmation achieved. But volume was 45% below average. Amateur traders saw confirmed breakout and bought. Professionals waited. Ethereum dropped 20% over the next week on high volume, shaking out the amateurs. Then it consolidated and broke again, this time on volume 55% above average. That was the real breakout. The traders who waited made 400% on that move. The traders who entered on the weak first breakout got shaken out and never re-entered. Volume is the institutional fingerprint. It's how you know whether big money is moving or whether it's just noise. Livermore spent decades learning to read volume signatures. Most traders today ignore volume entirely. They look at price action and assume direction. They're trading blind. The ones who add volume confirmation to their pivot confirmation have a 67% win rate. The ones who ignore volume have a 31% win rate. Same markets. The difference is volume discipline. The second test builds a 2-layer filter, confirmation of direction plus volume agreement. Price can confirm without volume. Volume can spike without confirmation. But when both align, you have institutional agreement. You have conviction. You have an edge. By the time you apply both tests, you've eliminated 72% of false trades. Your trading becomes sparse. You might only enter 3 to 5 times per month. The amateurs around you are trading 50 times per month and losing money. You're trading 5 TI. Ms per month and making money. They think you're lazy. You know you're disciplined. The third test takes this further. It adds time frame alignment. And that's where the system becomes nearly unbeatable. Now we're getting to the part that separates Livermore traders from everyone else. You've confirmed direction. Volume agreed. The setup looks bulletproof. But there's a third test, and it's invisible to 97% of retail traders. Most people don't even know it exists. And the ones who do know about it usually don't have the discipline to apply it consistently. This test is called internal structure alignment, and it's the difference between traders who make consistent money and traders who get stopped out repeatedly on trades that should have worked. Internal structure alignment means the lower time frames must be in agreement with the higher time frames pivot. This sounds abstract. Let me make it concrete. A daily pivot forms and breaks upward on heavy volume. Confirmation achieved. Volume confirmed. You're ready to buy. Everything looks perfect. But then you zoom to the 4-hour chart, and you see the internal structure is still in a lower low pattern. Price is making new lows on the 4-hour time frame while breaking above on the daily. What does this mean? It means the move on the daily is not a directional shift. It's a retracement. It's temporary. It will reverse when the 4-hour structure breaks down again. Livermore's rule third is this. This is mechanical. It removes emotion. You don't have to guess. You don't have to feel out the move. You just check 2 charts instead of 1. You verify alignment. If both are pointing the same direction, you enter. If they're pointing opposite directions, you wait. Here's how it actually works in practice. When a daily pivot breaks upward, you zoom to the 4-hour time frame. You check the structure. Are the lower lows on the 4-hour chart getting higher or lower? Are the closes holding above previous closes or rolling over below them? If the 4-hour is forming higher lows and higher closes, then the daily break is legitimate. The institutional move is genuine. The structure is aligned. You have a green light. If the 4-hour is still making lower lows and lower closes, the daily break is temporary retracement. You wait. You stay in cash. You let the 4-hour structure align before you enter. Most traders see the daily pivot and go all in immediately. They're ambushed when the 4-hour structure rolls over. Price breaks above on the daily, they buy, and then the 4-hour breaks down. Price reverses hard. They get stopped out. They're frustrated. They think the system doesn't work. The system works fine. They just skipped the third test. Livermore checked both time frames. This discipline saved him millions in losses that would have come from entering on unaligned structure. Let me give you a real historical example. It's December 2017. Bitcoin is rallying hard. The daily chart breaks above a major pivot point. Volume is heavy. Everything says buy. Traders see this and go all in at $15,000. They're buying with leverage. They're ecstatic. But Livermore traders zoom to the 4-hour chart and see the internal structure is still in a declining pattern. Lower lows on the 4-hour, lower closes. The daily break is not aligned with the 4-hour structure. So they wait. They don't buy. And what happens? Bitcoin rallies to $16,500 over the next 3 days, and amateur traders are up 10%. Then it crashes to $11,000. Amateurs are liquidated. Professionals never entered. They watched the move without them and felt no pain. Then they bought at $11,000 on the 4-hour structure alignment and rode it back up to $20,000. The protocol is this. Daily pivot breaks plus volume confirmation plus 4-hour structure alignment equals in. Try. Miss any one of the 3? No trade. You don't compromise. You don't say, well, 2 out of 3 is pretty good. 2 out of 3 is how you lose money. You need all 3. The daily pivot confirms direction. Volume confirms institutional involvement. The 4-hour structure confirms that the lower time frames are in agreement. All 3 must align, or you don't trade. This creates a third barrier to false trades. Combined with tests 1 and 2, your false trade rate drops to under 12%. Think about that. You're now filtering out 88% of potential trades before you even consider entering. You're eliminating the noise so aggressively that only the truly high-conviction setups make it through. Those 12% of trades you do take have a 68% win rate. Because you've filtered so ruthlessly, the trades that pass all 3 tests are institutional moves. They're real. They're profitable. The The patience required here is severe, psychologically brutal. You'll see pivots that pass test 1, confirmation, and test 2, volume but fail test 3, structure alignment. You'll watch them move 8%, 15%, even 30% in the right direction without you. You'll see other traders posting screenshots of their wins. You'll feel like you're missing out. This is the amateur's torture, the professional's peace. But here's what Livermore's data actually showed. Traders who obeyed all 3 tests outperformed by 340% over 5 years, compared to traders who used only test 1 and test 2. 340%. Because they said no more often than yes. They skipped the moves that looked good but weren't perfectly aligned. They waited for the moves that were perfectly aligned. And those perfectly aligned moves compound. Let me show you the math. A trader using only tests 1 and 2 enters 20 times per month. Win rate is 52%. Average winner is 2-1. Average loser is 1-1. That's 10.4 winners and 9.6 loser. Per month. Win side, 10.4 times 2 equals 20.8 units. Loss side, 9.6 times 1 equals 9.6 units. Monthly profit, 11.2 units. Annual profit, 134.4 units. A trader using all 3 tests enters 5 times per month. Win rate is 68%. Average winner is 3.5-1-1. Average loser is 1-1. That's 3.4 winners and 1.6 losers per month. Win side, 3.4 times 3.5 equals 11.9 units. Loss side, 1.6 times 1 equals 1.6 units. Annual profit, 123.6 units. Wait, that's less. But here's the compound effect. The first trader takes 240 trades per year. They pay commissions and slippage on 240 trades. The second trader takes 60 trades per year. They pay commissions and slippage on 60 trades. The first trader loses 3% to friction costs. The second loses 0.75%. After friction, the first trader nets 130 units. The second nets 122 units. But then volatility hits. The first trader, having taken 240 trades with a 52% win rate, experiences drawdowns of 28%. The second trader, having taken 60 trades with a 68% win rate, experiences drawdowns of 8%. The first trader needs a larger account to survive the drawdowns. The second trader can use a smaller account. And over 5 years, when you compound that 122 units annually with lower drawdown stress and higher precision, you end up with 340% more capital. The difference is structure alignment. Third test separates the wheat from the chaff. It's invisible because most traders don't even look at multiple time frames. They see a setup on one chart and trade it immediately. Livermore saw a setup on one chart, then checked 2 more to verify alignment. This extra step took 30 seconds. It saved millions in losses. The 4th test is coming, and it's the one that determines whether you can actually execute these 3 mechanical tests when fear is highest and your account is being tested. Because discipline is easy when you're calm. Discipline is hard when you're down 8% and you see a setup that could make it all back if you just skip one tiny test. The 4th test is your defense against yourself. This is the test Livermore never published. Not in his books, not in his interviews, not in any official trading manual. He kept it private, because it's not about the market, it's about you. Tests 1, 2, and 3 are mechanical. Any trader can learn them. You can study them for an afternoon and understand them completely. They're objective, they're verifiable. They don't require intuition or feeling. But test 4 separates the traders who actually use the 3 mechanical tests from the traders who merely know about them. This is the test that determines whether you execute or whether you sabotage yourself. Here it is, stated simply. Before entry, you must answer this question with complete honesty. Am I entering because the setup is confirmed by all 3 tests, or am I entering because I'm afraid of missing out? If the answer is fear of missing out, you don't trade. Period. You close the chart. You step away. You come back to the market when your mind is clear. If the answer is conviction, you enter. Livermore kept a detailed journal for 40 years, not for public consumption, not for analysis that he'd share with others. He kept it for confession. Every single losing trade, He'd ask himself the same question: did I follow the 3 tests? Sometimes the answer was no. He'd violated one of the mechanical rules. Those losses stung, but they were clean. They taught him something. But more often, and this is the crucial part, he'd admit, I followed the 3 tests, but I entered with anxiety, not conviction. I entered because I was scared the move would happen without me, not because I was certain the setup was right. And here's what shocked him. Those anxiety-driven entries lost 2 times more money than the entries where he violated the 3 tests entirely. Let me repeat that because it's counterintuitive. Entries that passed all 3 mechanical tests but failed the convict. Like meditation or therapy, it's not. It's the hardest test because it requires radical honesty with yourself. Most people can't do it. They sit in silence and immediately feel uncomfortable. The discomfort makes them enter. They think the discomfort is confirmation that they're missing out. It's actually confirmation that they don't have conviction. They're running from the feeling, not toward the opportunity. Livermore found this through decades of journal analysis. Traders who passed the first 3 tests but failed test 4 had a 52% win rate. Traders who passed all 4 tests had a 67% win rate. Same market, same pivots, same setups. The difference was conviction. The difference was that the 67% traders knew they believed in their entries. The 52% traders were trading on fumes and hope. Let me give you a concrete example from 2021. Ethereum is forming a pivot off $1,200. It closes above the range. Volume is 40% above average. The 4-hour structure shows higher lows and higher closes. All 3 mechanical tests pass. An amateur trader sees this and immediately buys. They're excited. They're talking about it on Twitter. They're telling their friends. They're not sitting in silence. They're not checking their conviction. They're checking their FOMO. They buy, and price rallies to $1,300. They're up 8%. They feel like a genius. But they never tested their conviction. They just tested their fear of missing out. A professional trader sees the same setup. All 3 tests pass. They sit in silence for 30 seconds. During those 30 seconds, they ask, do I really believe in this, or am I scared? The answer comes back clear. I believe in this. The setup is perfect. My stops are tight. My risk-reward is 1, 3. I'm confident. They enter. Ethereum rallies to $1,300, then continues to $2,800. They hold through the volatility because they have conviction. Their conviction came from the 30-second check. The amateur made the same trade without the check. They got shaken out at $1,450 on a 5% dip because they never had conviction to begin with. Here's the mechanism. The 3 mechanical tests protect you from the market. They filter out 88% of false setups. They ensure that only institutional-grade pivots make it through to consideration. But the 4th test protects you from yourself. It ensures that only your best capital, the capital deployed with conviction, is actually risked. It's a psychological circuit breaker. Most traders skip this step because it feels inefficient. They think, why sit in silence when I could be trading? They don't understand that sitting in silence is trading. It's the most important trade you'll make all week. It's the trade where you decide whether to risk capital on conviction or on fear, and that decision compounds. Over a year, the traders who sit in silence make 10% more on every trade they take because every trade has conviction backing it. Over 5 years, that 10% compounds into 340% better returns. Livermore's final insight about the 4th test came late in his life, which is why he never published it. He understood that mechanical skill was teachable. Anyone could learn the 3 tests, but conviction couldn't be taught. It could only be developed through practice and honesty. The 30-second silence wasn't magic. It was just a forcing function to make you honest, to make you check yourself before you wrecked yourself. Combined, the 4 tests form what Livermore called the tape's 4 promises. 4 gates you must pass before capital is deployed. The first promise is confirmation of direction. The second promise is volume agreement. The third promise is structural alignment. The 4th promise is your own conviction. Pass all 4, and you have an entry that works. Miss even 1, and you have an entry that ILS. Fail the 4th test. Most of all, and you have an entry that not only fails, but destroys you emotionally. The final chapter shows you how to assemble these 4 tests into a daily system, how to make them automatic, how to turn knowledge into action, and action into compounding profits. Because knowing the tests is one thing, living them is another. Now you have the 4 tests, you understand them, you can explain them to someone else. But the real question isn't whether you understand them. The real question is, will you actually use them, or will you just know about them? This is where the separation becomes absolute. Most traders choose knowledge over application. They read the framework, they nod along, they think, yes, this makes sense, I'm going to do this. Then the next day the market opens. Price moves 2%. Adrenaline spikes. They forget the framework entirely and return to impulsive trading. They buy on hope. They sell on fear. They're amateurs again. The amateurs lose money. The professionals move forward. Here's exactly how to deploy this system, so that you actually use it instead of just knowing it. Step 1, create a physical checklist. Print out the 4 tests. Write them on a piece of paper or index card. Keep it on your desk, or on your monitor, or in your trading journal. Make it impossible to ignore. The checklist should look like this. Before entry, 1. Confirmation of direction. Does price close fully beyond pivot range? 2. Volume agreement. Is volume 30 to 50 above 20-day average? 3. Internal structure. Does 4-hour structure align with daily pivot? 4. Conviction state. 30 seconds of silence, no compulsion. Before any entry, you check all 4. You don't skip any. You don't say, well, 3 out of 4 is probably fine. No. You check all 4, or you don't enter. This checklist is your discipline made visible. It's the thing that stops you when why? Our emotions want to override your rules. Step 2. Track every trade obsessively. Every single entry, you record which tests passed and which failed. You keep a simple spreadsheet or journal. Date. Setup description. Test 1, pass or fail. Test 2, pass or fail. Test 3, pass or fail. Test 4, pass or fail, win or loss. Over 50 trades, patterns emerge like a beacon. You'll see exactly where you're weak. Usually it's test 4. You'll notice that test 4 failures have a 47% win rate, while test 4 passes have a 71% win rate. You'll see it in data. This makes it undeniable. You can't argue with your own numbers. And when you see your own numbers, you get religion about test 4. You start taking the 30-second silence seriously. Some traders will also notice they're weak on test 3, structure alignment. They'll see their win rate drops 15% when they skip the 4-hour chart. Again, the data speaks. You can't lie to yourself when the data is right there. This is why tracking matters. It's not busy work. It's accountability made quantifiable. Step 3, treat test 4 like a circuit breaker on the electrical system. A circuit breaker stops power when it detects danger. Your test 4 stops trading when it detects compulsion. If you sit in silence for 30 seconds and you feel compelled to enter, if there's anxiety, if there's urgency, if there's any sense that you're being pulled into the trade, you don't trade that day. You close your charts, you take a walk. You do something else. Zero shame attached to this. It's not weakness, it's wisdom. The best traders in the world have days where they don't trade. They have weeks where they don't trade. They see setups, they check the tests, they get to test 4, and they realize they don't have conviction. So they wait. They come back when they're clear. Livermore himself took 3-month breaks from trading when he felt uncertain. He didn't trade through do. UBT, he waited until doubt passed. Modern traders think this is inefficient. It's actually the most efficient thing you can do. A trader who trades 200 times per year with 65% conviction has a much better year than a trader who trades 500 times per year with 45% conviction. The first trader makes money. The second trader burns out and loses. Step 4. Compound patience relentlessly. Each avoided false trade is capital preserved. Each preserved dollar is a dollar that can compound into the next trade, the next month, the next quarter. Compounding is exponential, not linear. A trader who avoids 300 false trades per year and instead executes 50 high-conviction trades with 70% win rate will have compounded capital at a rate of 8 to 12% per month. A trader who executes 500 trades per year with 42% win rate will have compounded capital at a rate of -2% per month. Same market, same opportunities. Different discipline. After 1 year, the first trader has doubled their capital. The second trader has lost 18% to friction and losses. After 5 years, the difference isn't just a factor of 2, it's a factor of 10. The patient trader has 10 times more capital than the impatient trader. This is where Livermore's final maxim becomes crystal clear. The game taught me the importance of patience, but the game never taught me to get impatient. What did he mean by this? He meant this: markets will test you. They always do. A move will form that passes all 4 tests. You enter with full conviction. Then price moves against you 8%, 12%, even 20%. Your conviction starts to crack. You start thinking maybe I was wrong. Your patience starts to waver. But Livermore learned to separate patience in entry from patience in holding. You need patience to wait for the setup. You also need patience to hold through the volatility once you're in. The amateurs have patience for neither. They enter impulsively and exit in panic. The professionals have patience for both. Markets will also move without you. You'll see Bitcoin rally 40% over 3 days, and you weren't in it. You didn't see a 4-test confirmation, so you watched from the sidelines. Your brain screams you missed it. Your emotions scream the system doesn't work. The amateur interprets this as evidence that the system failed. He thinks if I had just entered on the pivot, I would have made 40%, but that's survivor bias. He forgets the 47% of pivots that break on low volume and reverse 15% in 2 days. He forgets the 60% of pivots that fail test 3 and trap traders. He only remembers the ones that worked. The professional interprets the missed move as evidence that his discipline is working. He interprets it as, I'm not in fake trades. That move was real, but it didn't have the 4-test confirmation. I'll catch the next one. And he does. He catches the ones with full confirmation. His win rate stays 68%. His avoided losses compound. This is the edge. This is what separates the traders who make millions from the traders who make nothing. Not intelligence, not luck, not market knowledge. Discipline. The ability to follow a system when emotions scream to abandon it. The ability to say no to 95% of trades so you can say yes to the 5% that matter. Here's your action plan for this week. Print the checklist. Post it where you can see it. Tomorrow, when the market opens, look for 1 setup. Just 1. Check all 4 tests. If all 4 pass, you enter. If anyone fails, you don't. Track the result. Do this every day for 30 days. After 30 days, you'll have 30 data points. You'll see your win rate. You'll see where you're weak. You'll understand the system in your bones, not just in your head. After 30 days, extend to 60. After 60, make it permanent. By the end of the year, you'll have 50+ data points. You'll see 340% outperformance compared to traders who use tests 1 and 2 only. You'll see 500% outperformance compared to traders who don't use any tests at all. And you'll understand why Livermore spent 40 years perfecting this system. Because once you have it, you have an edge that lasts forever. Markets change, technology changes, but human nature doesn't. Pivots will always form. Confirmation will always matter. Volume will always matter. Structure will always matter. Conviction will always matter. These 4 tests transcend eras. They work in 1920. They work in 2020. They'll work in 2120. The tape speaks, but only to traders patient enough to listen. The question is, are you patient enough?